Hi, everybody, and welcome to the second set of financial lectures. Hopefully, you've watched already the introduction to financials. You've watched the video snippets and the podcasts, and hopefully, you've started to begin some of the readings. That is why last week there was no assignments due because there was a lot of material for you to start to begin to cover. This week, we will have a financial assignment. That assignment I will actually not have due for 2 weeks from today of the posting, and that is more so you can still take time in catching up on those readings and doing that. When I did the introduction video, I talked about the difference between fiscal exam and physical exam. Fiscal exam is obviously how we analyze a business, whether it's a traditional community pharmacy, whether it is a restaurant, whether it is your consulting business. I've talked to numerous of you over the last couple weeks about your business ideas, and they were all great. And they're not all traditional community pharmacies, and that's great also. But we'll use community pharmacies as our reference for these financials, but these financials can be applicable to any type of business. Physical exam, how I compare that is obviously when we're getting our physical to examining if we're healthy, we're going to look at target things. We're going to compare how does our blood pressure compare to where it should be on average for healthy individuals. We'll look at our weight. How does that compare to people on average who are our age, our height in terms of healthiness? We'll look at labs and how they compare. So physical exam is doing the same thing. Because with comparative analysis and ratio analysis, lots of people use these. We use these to make our own managerial decisions. Bankers and investors look at these on whether or not they're going to continue to finance what we're interested in, to beginning to look at our projections of why we're worthwhile to finance, or to give us additional money, or to increase our credit line. We talked about in the introduction lecture the difference between a profit loss statement and a balance sheet and how they kind of are similar together. But in an income statement, the income statement is a very good tool to help you from a managerial standpoint. Because when we look at comparative ratio analysis, we're always going to look at how are we doing compared to sales. And we do that by looking at multiple different things. We look at areas of solvency, which if you remember, that's how we can quickly have access to cash flow. And remember, cash flow, cash is king. It's how we pay our bills. It's how we pay our payroll. Efficiency. A lot of times we may have poor cash flow due to we are not running the business efficiently. And this can be due to operating expenses, to inventory control. And then obviously profitability. And that's one of the reasons why you're willing to take that risk as an entrepreneur, to gain more, to help yourself, to help grow your business ideas, to help support your family. Solvency, just to go over these ratios real quick, is the overall ability of the firm to pay its legal debts. So we're always going to be looking at things such as, remember, current assets are those things we can turn into cash really quickly versus our current liabilities of things that we have to pay on a monthly basis. Obviously, just like in your own personal finance, we need to be bringing in more money to be able to pay those liabilities, and hopefully we have a little bit left over to be able to reinvest into our company or to save for a rainy day. The asset test ratio. I'm going to go through these fast, so if you have any questions, please go back and refer to the introduction lecture. The asset test ratio, it's looking at the cash we're bringing in along with the bills, things that people owe us, accounts receivable. If it was a traditional community pharmacy, this would be our third-party insurances. And are they enough to cover our current liabilities? And we at least need to be them at a 1-to-1. All right? Greater than 1-to-1 is great. Less than 1-to-1 obviously is not. Also, too, if we are in a traditional business where we have inventory can tie up cash flow. And so we need to look at how is our ending inventory to our current liabilities. Obviously, this should be less than 50% because we want to make sure that our inventory is not overly high to compare to what we owe. Our liabilities to our net worth. Obviously, we want our liabilities to be less than what we're truly worth, or this is where somebody starts thinking about filing for bankruptcy. Fixed assets. Those are those assets we can't turn over into cash right away. Those might be buildings. Those might be fixtures. Those might be the company car. We want those to be at least in a range of 25 to 50% of the net worth. Long-term debt, debt that helps, our loans, all right, our mortgages, for those. We want those to be definitely less than 50% of our net working capital. Efficiency is how well we manage our business. And if we are doing a business where inventory is part of that business, we're going to look at, our cost of goods sold to average inventory. That usual range of turnover should be about 8 to 11. If we look at our annual sales, our average inventories turnover should be about 12 to 14. I've been told, and even in looking in my own businesses, that with MedSync type of implementation programs, using good software where you're doing what's called perpetual inventory ordering, where the computer is helping you determine what is your reorder points, you can get that turnover rate even into the high teens and to the low 20s. Why is that important? Because the less you have on your shelves, but still be able to meet the demands of your patients and customers, the less cash you have tied up in inventory. Our net working capital, the definition of that is current assets minus current liabilities. So what is our net working capital turnover? That looks at our annual sales to our net working capital. That should range from 5 to 12. There's also, we can calculate our degree of newness of fixed assets. That should be greater than 50%. If it is less, then maybe, our fixtures, our cars, maybe we need to do a little bit of remodeling and upgrade because they are getting old. We also need to look at, how well people are paying us. So we want to, hopefully people are paying us within 30 to 40 days. If we go beyond that, yes, we can charge finance charges, but that is cash that we are not having coming into the company. And that is why, too, when you are dealing with third-party insurances in the community pharmacy realm, we need to be always looking at our reconciliations. Are we getting paid for what we've billed out? There are services that can help you with that, but you always want to be sitting on that. If you're a consulting company, obviously you need to be sitting on that too to make sure that people are paying you in a real time, because your consulting, your subscription fees, if you're a software, type of pharmacy company, that all is how you're going to, that is your sales, that is your cash. Payable conversions. How quickly do we pay people? A lot of times if we're talking about traditional community pharmacy, you're needing, you want to be able to pay your bills within a 15 to 25 day realm. I told you most third parties are paying us within 3 weeks. If you can pay within 15 days, a lot of times you get better discounts. If you go beyond 25 or 28 days, that company then may charge finance charges. And for those who are familiar with credit cards, if you have a credit card of $100 and you have an annual, finance charge rate of 18% per year, $100 of 18% for that whole year, that's not a lot. But if I am talking about a pharmacy bill where I owe $400,000 to $600,000 for just that 1 month, we're talking about maybe thousands in dollars in finance charges. Profitability. Obviously, that is the bottom line. It's important. It's not the only measure of business success, but this is one of the reasons why you went into to take that risk as an entrepreneur, is to be able to, live better, to be able to have a way to finance your ideas, your passion. Pharmacy itself, traditional community pharmacy, is not in the highest net profit range. It's anywhere from 2.8% now, probably to 5%. That range is probably an older range I need to update. However, if you get into the consulting business, you can get into specialty, you may see that push up to 8. We are pretty much comparable, I always say, to the grocery store business, which runs on a pretty tight 2 to 3% margin. However, if you're talking $3 million in sales to 3%, that's still a good net profit. We also want to look at how is our net profit to our net worth. All right, when we look at our net worth, what is our total assets? What's our total, that we have? We want our net profit to be within 20 to 30% of that. Net profit to total assets. This usual range is 10 to 25. Net profit to inventory, net profit to net working capital. When you first start out in a pharmacy business, obviously the bank knows you're not going to be there at profitability right away. Most new companies, it takes 18 to 24 months to get to profitability. And that is why you need to show a good pro forma, a good financial projections that you can get there within that time frame, so that they're going to give you enough line of credit to help you get there and to sustain the business till we get to that profitability state. So that was just a quick snapshot overview. We talked about those slides in the introduction lecture. What I'm going to talk to you now about is giving you an example. So we have Healthcare Pharmacy Anytown USA, and I have attached in a separate file on Blackboard this file. It's an old file. It's a little bit, the scanning ability of it to be able to keep it intact, but it's a great teaching tool. Some of the numbers may not be, applicable to 2019, but it's just a teaching tool. So let's take a look. So this is figure 4. So this pharmacy is sales are around 2,790,000, which it all depends upon the pharmacy now. With decrease in reimbursements, sales are usually at least within $3 million. A very super busy pharmacy, we may be in the high 4s and 6s. Obviously, the one thing, what we're always doing when we're doing these comparative analysis ratios, we're looking at that towards sales. And so what one of your exercises are going to be is we are going to take this and look at it towards sales. So one of the ways we calculate the cost, our purchases, is we look at what our beginning inventory was and what our ending inventory is. And so currently right now, if you look at, there was a 20,000 difference between our beginning and the ending. So our total cost of goods sale was like $2.5 million. If you look at that compared to sales, that's about 80%. And 80%, we'd like to see our inventory compared to sales to be around the mid 70s, not low 60s, but high 60s would be awesome. But that is a reflection of maybe our inventory is too high. The other thing is looking at our gross margin. All right, if you look at the gross margin to this, our gross margin is about 19.3%. That is kind of about on average where gross margin should be. When we combine OT sales and back end sales, we'd like that to be around 23%. Where do we get a lot of these numbers? We get a lot of these numbers from the National Community Pharmacy Digest. And so this is an older example that I have posted for you, but I will share with you, especially next semester, if you're doing a traditional community pharmacy, what the National Community Pharmacy Digest says. How do they get this digest? Well, what happens is every year they ask for people to send anonymously their P&Ls, and they compare those. The downside of this is that usually the people that do send those is people that are doing well. Most of the time, poor pharmacies don't share their data, but at least it gives you a range, a ballpark way to guide. And when you're dealing with a bank who may not understand pharmacy, it's a great way to do that. So the one thing too, when we're doing comparative analysis, we always want to look at where's our employee wages, all right? Where is our rent at compared to what it should be on average? And we're doing all these comparative things to sales. So for example, in this example, our net profit before taxes was around $37,200. We are a little bit low compared to what the NCPA average is at 2.9. We look at what our owner's withdrawal is. We look at what our income is receiving. All of these things are reflective. One of the things we do too is we look at our balance sheet. We look at, where's our cash, where's our accounts receivable, where's our inventory. And so if you take a look at, this pharmacy, we are not doing very well in cash. If you look at, we're not doing very well in accounts receivable. So that kind of reflects of why we have poor cash, is we're not collecting our payments in an envelope time. When we can compare our inventory to what the NCPA average is, we're actually high there. So a way to be able to help improve cash flow, help to improve efficiency is to take a better look at our inventory. What's our reorder points of our inventory? What is our purchasing? How are we purchasing? Can we purchase better? And can we collect our bills better from those who owe us money? When we look at the liabilities of this business, look at its liability of accounts payable is $186,000 compared to what the National Community Farm Association says is 9.3%. So we might need to look at our expenses. Our notes is obviously what our current loan is. That's a little bit higher than the national average, but at the same time, we might not be able to renegotiate that until we get our other numbers better. Our current liabilities is not doing too bad, and so there's our current liabilities at $241,000. We also always are looking at what our net worth is and what our payables are and evaluating those. So if we take a look at some of these ratios, all right, if you take a look at, what we were talking about before in terms of doing tests. So if you take a look at, this person, their current ratio is 3.5, all right, which that's not bad. But if we take a look at what's happening over the 6th, 7th, and 8th year, all right, and we were looking, I shared you with the 8th year financials, and what you're going to be doing for an exercise is you're going to be calculating the 9th year. What do we notice? We notice that the current ratio is going down. And so what does that mean? Our ability to pay our bills is not where it should be. So we have to be careful with how we are doing there. Okay? Our asset test ratio, where we'd like that to be a 1-to-1. All right? What has occurred? We've seen that was a slightly high, and that's been fluctuating over time. So once again, this is probably a reflection of what we were talking about earlier, that our cash flow was poor and our our accounts receivable was not where it needed to be. If I look at our current liabilities to inventory, what is this telling us? Well, this is telling us that, we are, obviously trending up. We'd like to be less than 50%. So that means that, we probably got, just like I said earlier, we got more inventory on our shelves than needed. And so we may need to take a look at this. If we look at our total liabilities to net worth, all right, we'd like this to be below 100%, and we're doing okay, but our liabilities are creeping up, and that's probably because we got too much inventory on our shelves and we don't have enough cash flow coming in to pay those liabilities. Our fixed assets to net worth, all right, we'd like this between be the 25 to 50% range. It has slowly creeped down over the last couple of years. And so we may need to take a look at why has the value of our assets gone down. We may have to reinvest. However, we're going to need more cash flow to be able to do that. Our long-term liabilities to net working capital. Obviously, our net working capital is what our current assets are to total current liabilities, and we're hoping that our assets are greater than our liabilities. And this is actually, below that 50%, so we're not at desperate stage right now. So when you look at our overall solvency report, our current ratio is okay, but there's a negative trend. Our asset test shows that we do need to decrease our inventory, and our current liabilities to inventory shows we need to decrease our current liabilities. All right, our total liabilities we need to decrease, and we need to increase our fixed assets. So we probably need to reinvest what our fixed assets are. If we look at our efficiency ratio, we look at our inventory turns, those have gone down. And the one good thing is when you look at efficiency, solvency, and profitability, if there's a problem, they're going to show up in pretty much all those ratios. One may take a little bit longer than the other to show up, but they will show up. So if you take a look at our inventory, and obviously our annual sales to inventory definitely reflects that, we need to do something about this. If you look at our accounts receivable, yes, we're not getting paid within that 35, 40-day range, and this is where our cash flow is hurting. And because of this, we're creeping up in our time to pay. We're still paying our bills pretty well on time, but if the trend continues, our ninth year might be a tough year in terms of that. Our net working capital turnover is okay, but it's trending up. And our degree of newness of fixed assets, that is actually decreasing too over time. So our total turns, our accounts receivable, we need to decrease our inventory. We need to be more aggressive. I will share with you there are times where I go back and look at maybe, a third party forgot to send us a check, or it got lost in the mail, or somehow there was some type of discrepancy. Those things you can do your own self within your books, within your accounting, and that is why whether you are a traditional community pharmacy or whether you're a consulting company, you need to have good books so you're able to track who owes you what, so you can be aggressive in your collection of that. We also need to take a look at our fixtures and maybe need to provide some remodeling. When we look at our profitability, what's occurred over these 3 years? Obviously, we've seen it gone down. And that is maybe due to our operating expenses have gone up. However, it might be our annual sales have gone down. The return on net worth to total assets, obviously, it's the same trend. We're seeing that go down too. So our net profit to total assets have gone down. Our net profit to inventory has gone down. And the same with our net working capital. So this profitability report says the exact same thing that happened in solvency and efficiency. We need to decrease our cost of goods. Maybe we need to change our pricing. Some things we don't have control over in the traditional community pharmacy, but maybe you do have that in consulting. Maybe you need to look at other types of over-the-counter lines. Maybe you need to get into things like CBD, or maybe you need to get into other things that are not tied to third parties that you can control what you get paid for that. We also may need to look at, because our sales are down, we may need to look at our operating expenses and do we need to have as many people on the payroll. So, the next thing that you will be doing is doing projections. And I'd like you to be able to doing projections. And what you'll be doing is you want to make projections if your project sales are at $3.4 million. Your cost of goods, you'd like to get to 79%, and you make your net profit of 3% sales and increase your owner salary to 3% sales. This is how we do projections. And I will work with you next semester when you're doing your financial business plan of how to do this, because a lot of times your projections are going to be from square one. But this is how a manager is doing that. Some other financial objectives for your ninth year is you want to pay your bills on time, so you want to decrease your accounts payable collection period to 25 days. You want to project personal expense at 9% of sales, and you want to decrease your inventory by $48,000. So what do we do? For step one, we're going to take our total sales. That's what we're projecting we'd like to be at. Step two, we're going to put what our cost of goods we'd like to be at. And then step three, we're going to put where we'd like our gross margin to be at. And then we can then also, step four, put where we'd like our proprietor's manager's salary to be. We can then have a goal of where we'd like our employees' wages, and where we'd like our net profit before taxes, and where we'd like our total expenses to be. Now, remember, the only way, though, for those numbers to occur is we then have to act. We have to do things such as, take a control of our inventory. We need to look at, where else could we cut expenses? Can we relook at what we're paying in internet? Could we look at what we're paying in phone? Could we look what we're paying in insurance? And then maybe we do those before we look at, salaries. All right? So our goal is maybe to decrease it by 48,000, but how are we going to do that? Well, we go to our fiscal shelves and we take a look at that. We look at what our reorder points are. How much are we keeping? There's lots of ways you can do this manually. You can do this with computers, but this is the overall goal to help out with this. Okay? And hopefully by doing this pro forma, we can actually see an increase in our numbers get better, our increase in prescription sales, and we can go from there. Okay? So I'm going through those rather fast because that's kind of walking through that. That's how we do projections. But what I'd like you to do is you'll see the assignment. Please go back and watch the readings, the financial projections, and we will walk through this. Like I said, I'm not going to have this assignment due